Thank you, Stanford. On behalf of Edelweiss, let me welcome you all to the Q3FY18 earnings call of Prabhat Dairy. From the management today, we have Mr. Vivek Nirmal, the Managing Director, and Mr. Raviraj, the CFO of Prabhat. So without any further ado, I'll hand over the call to Mr. Nirmal for his initial comments, post which we'll open the floor for Q&A. Thank you, and over to you, Vivek.
Thank you very much, Radha. So, good morning, ladies and gentlemen. It is a great pleasure to welcome all of you to this conference call to discuss the earnings for third quarter and first 9 months of financial year 17-18. We had announced our Vision 2020 plan in October 2017 and had devised a focused roadmap to grow our consumer business share from 30% to around 50%, introducing product variants with attractive packaging, strengthen our retail footprint by doubling our general retail reach from around 1 lakh outlets to around 2 lakh stores, and also grow our presence in modern trade. Increase our milk procurement capacity by focusing on direct sourcing, and lastly, strengthen our scale in institutional business. We have already started taking steps in the desired direction towards achieving our Vision 2020. During the third quarter, we have grown our modern trade presence from 289 centers to around 320 outlets. Our general trade division expanded from 1 lakh to around 1,25,000 stores. We have launched our exclusive retail stores in Maharashtra, branded as the Goodness Zone. These stores are operated on franchisee-owned, franchisee-operated model. This will help to take Prabhat Dairy's entire range of existing and new products directly to the consumer. We plan to launch 500 exclusive retail stores in various districts and talukas across Maharashtra by 2020. We are investing in strengthening and growing our direct sourcing network with an aim to take Prabhat to every household. We are focusing on building our fresh milk distribution network, which will take our house milk to every household in our target market. Coming to the financial performance of the quarter, we witnessed an improving trend on quarter-over-quarter basis with an increase in revenues and profitability. Q3FY18 revenues grew by 4.8% Q1Q and declined marginally by around 1% YOY basis to around 404 crore rupees. Revenues declined in value terms on YOY basis due to a decrease in around 14 to 15% in terms of milk prices. There was a healthy volume growth though across various products, largely driven by increase in sales of liquid milk, cheese and curd. Share of value-added products, milk and milk was around 79 and 21% respectively. Q3FY18 gross profit grew by 10.7% QOQ and 19% YOY to rupees 93 crore. Gross margins increased to 23% in Q3 compared to 21.8% Q2FY18 and 19.1% in Q3FY17. This was basically driven by lower milk procurement price, which decreased by 9.4% QOQ and around 14.7% YOY, which is right now around 23.2 per liter in Q3FY18. Our Q3FY18 EBITDA grew by 18.7% QOQ and was stable on YOY basis at around 57.9 crores. EBITDA margin increased to 9% in Q3FY18 compared to 8.3% in Q2. To accelerate company's progress towards Vision 2020, company took a conscious decision of reinvesting the benefit from improved gross margin and building and expanding the consumer business. There was addition in manpower to expand the direct sourcing of milk network as well. This helped in increasing the average per day milk handling from 8.5 lakh liters compared to last year to around more than 10 lakh liters in the last quarter. There was an increase in selling and distribution expenses as well to expand the fresh milk distribution network. Increase in the share of consumer sales also led to higher transportation costs as the company is expanding its reach and presence, particularly with the cold chain network. Q3FY18 PBT before exceptional items grew by 53.1% QOQ, however declined 10.6% YOY to rupees around 16 crores. Q3 PAT grew by 62.5% QOQ. And PAT margin improved to 3.7 compared to 2.4 in Q2FY18. One more thing about the budget, the recent union budget proposed an allocation of around 13,000 crores to the dairy farming infrastructure and fisheries. Animal husbandry has been facing a major challenge, basically due to low productivity, which can be attributed to cattle breeding, distress health, and availability of high quality fodder, which is also led to lower output and quality of milk. We are glad at the government's proposal for funds allocation, which will help dairy farmers involved in animal husbandry. This move is to boost farmers as it will further enhance the yield from animals, quality, and enhance more income for farmers. This is also a part of government's objective of doubling farmers' income by 2022. A higher production of milk will also lead to increase in productivity, which in turn will help in the overall industry.
Excuse me, this is the operator. I'm sorry to interrupt. Mr. Nirmal, your voice is not clear. It's feeble.
Yes, 1 minute.
Sorry.
Is it clear now?
Yes, it is. Thank you.
Yeah. Higher production of milk will also lead to increase in productivity, which in turn will help in generating higher revenue for dairy companies like us as well. With this, I would like now to proceed with question and answers, and I leave the floor open.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. We take the first question from the line of Anirudh Joshi from ICICI Securities. Please go ahead.
Sir, just two things. One, the milk prices have fallen, but why we are not able to keep the entire benefit, whether we have to pass it on entire benefit to end consumers. We can understand that with B2B consumers, but why are we required to pass on the entire benefit in case of B2C sales as well? And secondly, can you elaborate more on the 500 new store strategy, whether it will be own stores, whether it will be franchisee stores, roughly what is the store size and what is the revenue target that we are looking at, and why are we getting into the own stores when we can anyway build the distribution network via the Kirana stores and the modern trade, etc.
Great. So now to answer your first question, since 60 to 70% of our revenues come from the ingredient business, obviously the milk prices are passed on. Hence, last year when the milk prices were up substantially, we again saw very stable margins of around 8-9%. And even when this year the prices are down, the stability of margins is maintained. Number one. Number two, in terms of consumer business, we have not passed on the milk prices decrease to the consumers. The MRPs of our products are same. And hence we can see a healthy gross margin increase from 19% to 23%. However, our EBITDA right now is still at the same level. Reason being, it's a conscious call by management to reinvest the additional gross margins, additional revenues in the form of discounts to be passed on to the consumers. Second is discount for the trade, and third is particularly for building more sales and distribution. So the price reduction benefit has not been passed on in terms of the consumer business segment, but it has been reinvested particularly to grow the business, which is a good opportunity for us right now. Number one. Number two, in terms of retail stores, 500 stores, these are not company-owned stores. These are particularly managed by the retailers, the franchise. The only difference is that right now, while we have a very good general trade reach, but there are a lot of general trades who don't stock the entire of the product, because we have a larger presence in tier 2, tier 3 towns, and there the availability of chillers and freezers is not very large. What we have observed is Prabhat Dairy is now recognized as an umbrella brand, and people give more preference, the consumers have more preference to the products from the same brand. So it is important for us to make all the products available under one roof, which could in turn drive sales in that region. That's the reason for having exclusive stores. The model is completely franchisee owned, it's franchisee operated, it's not owned by the company, but it's going to be a very standard process. We believe in building models and then ultimately replicating those models after perfecting them in an area. So right now, we have piloted some of the models, the stores, perfected it, and now we are expanding it. So the revenue target per outlet is in the range of around 7,000 rupees to 9,000 rupees per day per outlet. That's the revenue target. The benefit for us is that we also have ice creams in our basket now. And with ice creams, really the retailers' ROI is much better because there is a very good margin for the retailers, particularly in terms of ice cream and all. And these outlets are going to be directly serviced by the company. There is no intermediary in that. So that's a learning actually what we have got from our direct sourcing. It's a very similar kind of a business over here. We have the idea and capability of managing the logistics, cold chain logistics. That's the capability we are utilizing here. And so then the target in next 2 years is to get this outlet around 500 in terms of numbers.
Okay. Lastly, where do you see the milk prices now? In case of Q4, already 1.5 months is over. So do you still see milk prices remaining at lower levels, or is there any uptick seen?
The prices are stable. The Q4 and Q3 prices, I would say, more or less are at the same level right now. And we don't see any increase happening in the milk prices in this quarter.
Okay, sir. Thank you.
Thank you.
Thank you. We take the next question from the line of Percy Panthaki from IIFL. Please go ahead.
Sir, if I look at your top line on YOY basis, it's more or less flat, and you mentioned the reason is because of the milk price deflation, and the volume is actually healthy. So can you give us an idea approximately what would be the volume growth on a YOY basis?
So YOY basis, if you see this year, 9 months, our value growth is also there. It is not there just only on the Q3 YOY basis. Otherwise, on 9 months basis, it's around 9 to 10% even in terms of value. In terms of volume, the volume growth is around 15%. 14 to 15% is our volume growth on a YOY basis.
On YOY basis, 14 to 15%
yes.
Volume growth. Okay.
Yeah.
Okay. And so this 14 to 15% is for this quarter, right?
Yes.
Okay. And again, if I see for this quarter, basically your EBITDA is flat. So just wanted to understand, with a 14-15% volume growth, flat EBITDA, that means on a per unit volume, let's say per liter of milk or whatever, your EBITDA is actually lower YOY. So why would that be the case? I understand you completely pass on the benefit to the consumer, but that should mean that on a per unit, your EBITDA remains flat and not decline.
Yeah, so that's correct. In terms of our ingredient business, we pass it on, and obviously our ingredient business is the strongest pillar right now. We are utilizing that business particularly to increase our business of the consumers. If you see on a gross margin basis, on a YOY, from 19%, our gross margins have increased to 23%. So due to the volume growth and also the other factors, our gross margins are definitely higher. But as I mentioned earlier, it's a conscious call. We are reinvesting all that money again, particularly in building distribution. In dairy products, cold chain network is required, and hence the distribution costs are higher. So initially it takes a lot of time, money and energy to build the pipeline. Once the pipeline is built, ultimately the volumes come in, and then the cost per unit goes down. So that's why in this particular quarter, our transportation costs are up. Since our sales team is expanding, our sales cost is up, discounts are up, and hence we see a margin which is flat compared to the last year.
But sir, aren't these costs which you mentioned pretty variable with the actual volume? I mean, your transportation cost or your feet on street or procurement cost, it will probably increase in line with the volume of business you do. So I don't know how you will get leverage on these costs in the future.
So if we see in terms of consumer business, right now from around a level of 400-450 crores, we are targeting it to at least increase it by 2.5 times by 2020 to 1,000 crores. So right now the entire consumer business, since it's in development stage, the percentage cost of transportation, logistics and sales is expected to remain higher. And once the volumes build up, the cost of this transportation or sales does not go in the same proportion. It remains where it is. But right now, since it is the foundation and we are building a particular sales and distribution, hence the percentage cost in terms of consumer business is higher.
Right. Understood. So, sir, for your entire company, you are clocking approximately EBITDA margins of about 8.5%. I'm saying over a 1 year, last 3-4 quarter average. So, could you give us an idea of how different it is versus in the consumer business versus the B2B business, the EBITDA margins?
So right now, EBITDA margins are similar in both the segments. Being in ingredients, while we are doing specialty ingredients, even in consumer business, while the gross margins are higher, but other operating sales operating costs are also higher. So right now, both the segments I would say are in a similar range of around 8 to 9%.
Okay. And as per your vision 2020, if you increase the proportion of consumer business from 30 to 50, supposing you achieve that, then at that point of time, what kind of EBITDA margins you would be able to make?
We are definitely expecting, I'll not be able to say the exact number, but we are definitely expecting a very good growth in the EBITDA than the current levels.
Okay, sir. That's all from me. Thanks and all the best.
Thank you.
Thank you. We take the next question from the line of Dhaval Mehta from Yes Securities. Please go ahead.
Yeah, good morning, sir. Thanks for the opportunity. So just to dwell a bit more on the franchisee model, so what are the contours of the model? Like, what is the franchisee fees which the franchisee owner has to pay? And ideally, what is the ROI which we are looking for the franchisee owner?
In terms of fees, so there is a nominal deposit particularly, against which we provide them with our freezers, chillers, and we also do the entire decoration of that particular outlet. Which costs around 70 to 80,000 rupees, and around 40 to 50% of that is the fees. Depending on the sales of outlet, we also have a different margin structure wherein ultimately the fees could be reduced if the outlet gives more business. And the ROI, particularly what the outlet owner should be looking at, is around anywhere in the minimum 25 to 40% per annum for that particular outlet, depending on in which region the outlet is located.
Okay. So first, I am assuming that we will be focusing more on the Ahmednagar and the Nashik area where our strength is much higher vis-a-vis the metros.
Yes, tier 2, tier 3 towns are our major focus area because we have a good distribution network over there. So relatively smaller towns like Nashik, Aurangabad, Ahmednagar, the interior part, particularly the talukas where the economic profile is much better. So these are the areas we are targeting, and here relatively the competition is quite low. The brand is quite strong, and our distribution is also quite strong. Hence, that's our preliminary target. After getting strong here, then we would be ultimately entering into the larger cities like Mumbai or Pune.
So ideally, sir, for a franchisee owner, what will be the ballpark revenue per store for him to break even?
So the revenue break even is in the range of around 4,500 to 5,000 rupees a day. But it also would largely depend on the mix, because certain areas would be selling more of fresh milk, but certain areas would also be selling more on the ice cream, depending on the location of the store. So it could range anywhere in between 4,500 to 7,000 rupees per day, depending on their profile of the product sold.
That's helpful. So my second question is that we have been very aggressive in GT in this quarter. So we've almost increased our presence by around 25% QOQ. So like in which particular geographical location we are focusing the most?
Actually, it's not a QOQ growth. It's actually the growth which we have achieved in this entire 9 months, the additional 25,000 outlets. And this is basically because we have entered into parts of Northeast with our UHT milk in last 4 or 5 months. We have also reached areas like Jammu and all with our UHT milk, which are relatively new geographies for us. And second is we are intensifying our presence further in Maharashtra, where we were not present earlier. For example, we have started our milk packaging in Latur before 2 quarters, wherein we are targeting the area of Marathwada in Maharashtra for our liquid milk products. So these are a couple of areas which have contributed to this growth.
So we can expect the run rate to be 25,000-30,000 annually for increasing our...
Absolutely, yes.
Okay, thanks, sir. Sir, my last question is a bookkeeping question. Sir, our tax rate has been very low in this quarter. Even if you see 9 months, it's around 18.4%. So, like, what is the annual tax guidance which we should build in?
Ravi, could you take this, please?
Right. So the tax rate will be.
Excuse me, this is the operator. Mr. Bhandane, we cannot hear you. Ladies and gentlemen, please stay connected while we check the line for Mr. Raviraj.
Hello, yes, Ravi's call is disconnected.
No problem, sir. I'll take this offline, sir.
Yeah. Or maybe you could again ask after 10-15 minutes.
Yeah, no problem, sir. Thank you, sir. Thank you and all the very best.
Okay.
Ladies and gentlemen, thank you for patiently waiting. We have the line for Mr. Raviraj reconnected. So you may go ahead.
Hello. Hi there.
Yeah, sir.
So the whole tax rate would be similar as per the earlier quarters.
Okay. Earlier quarters means, so in FY17, our tax rate was around 29%, so should we expect that it will be in the same range?
No, it will be similar for quarter 2, quarter 3 range.
Oh, okay. So
Quarter 3 we booked additional income, exceptional income. So that's why the tax rate was higher.
Oh, okay. So it will be in the range of 17-18%.
Right.
So this will be even for FY19, FY20, sir?
We can't comment on that immediately.
Okay. Thank you, sir. Thank you and all the very best.
Thank you. We take the next question from the line of Manish Jain from Sage One Advisors. Please go ahead.
Yeah, hi. I had two questions. The first one was on milk procurement. What's the peak procurement of milk that we're doing, and how much of is directly from the farmers at this stage?
So right now our peak procurement is what we are doing right now. I think is the peak. It's around 10.5 lakh liters, more than 10.2 to 10.5 lakh liters per day. Out of which around 7 lakh liters is directly sourced from the farmers, and around 3 lakh liters is sourced from third parties. And
when we are seeing a 15% reduction in procurement price, and you want to increase your procurement, this obviously leads to a significant reduction in profitability for the farmer. So what measures are you taking to ensure that you can scale up in the next 2 to 3 years from a farmer's perspective?
I think if we see particularly, while it is 15% lower, but I think we should consider that the prices last year were quite high. So even if they are 15% lower, I think farmers normally calculate an average that eventually, going what's the run rate for them and what has been there for the whole year. I think even today the prices are good. We are paying in the range of 23 rupees, which are very good prices to the farmer, number one. Second is even if the prices keep on, and prices are going to keep on decreasing and increasing because those are very closely into market mechanism. More important is to grow the productivity of animals. And as our Prabhat Dairy Quality Mission program, which is very successfully implemented since last 10 years, we focus extensively on 4 pillars, which is first is breeding, second is feeding, wherein we particularly take care of cattle feed and silage provision to farmers. Third is animal management, which particularly talks about the mechanization of the milking procedures and their loose housing, wherein the animal health is improved. And fourth is overall healthcare, which particularly talks about vaccination in advance, deworming activities, and the medical care for the animals. So these are 4 pillars we particularly work on. And we have seen consistently that these 4 areas where we have been working, the yield of the animals have improved from per lactation, which was around 1800 to 2000 liters. We have seen farmers in our area some of them which have gone even up to 4,500 to 5,000 liters per lactation. I think that is the most important solution for farmers when the prices are lower, and that has been our intervention particularly to ensure that the farmers stay in the business, their profitability is maintained, and they remain interested in the business.
Thanks. I'll join back the queue.
Thank you.
Thank you. We take the next question from the line of Kaustav Bubna from SKS Capital and Research. Please go ahead.
Yeah, hello. Hi. So just wanted to know, could you break up your year-on-year for this quarter specifically? Could you break up your year-on-year sales growth for the institution business and for the consumer business?
Yes, so we don't provide segment-wise breakup, Kaustav, but our the consumer business growth has been relatively higher compared to the ingredient business.
So just wanted to understand how we going to tackle this problem, because we have a sales target, you've set out a vision, and the institutional business is, in a sense, highly commoditized, because if milk prices fall down, you have to pass on the full benefit to your end customer. So, what if milk prices stay down? That's going to or go even lower than what it is. That's going to impact our overall revenue growth for years to come. And let's say that we hypothetically are in a low milk price environment for the next 1-2 years. So, how do we tackle this, this issue that we face because of our high institutional mix?
So, two things particularly. Yes, I think the milk prices are low, and there is a continuous situation which we have encountered in the last 18 years of the business, that there are a couple of years of low prices, couple of years of the high prices. So there is a cycle, and particularly second, there is also an impact of seasons, when we again see prices going up or going down. Now, most important in a dairy is not only to chase revenues, but also important is stability. Stability in terms of disposal of milk, stability in terms of revenues, and stability also in terms of margin. So as a specific decision, we have taken a call to have a strong business of our ingredients, and in ingredients which is stability and margin protection more than just leaving it open to the market environment. And hence, if you just see our business model, we are not into commodity products like skim milk powder or butter and all. We are into specialized ingredients which are customized according to the consumer's requirements. So most of our clients are the global clients or the large Indian food companies. Products are customized to their requirements, and hence the growth of ingredients is stable, which we have seen since last 7-8 years. Here, relatively margins are better, which we again compare to the commodity dairy players in the country. The model of cost to us is definitely of a great value. I just said to someone before 10-15 minutes that last 1.5 years back, we saw a huge spike in terms of milk prices, and that actually eroded a lot of margins of players because they were not able to pass on the same price immediately to the consumers. But in terms of our business, we were even stable at that point of time. Reason being, it's a cost-plus model. So while you cannot be getting the benefit when the prices are down, but you are also not at a great risk when the prices go up. So that's the call. Having said that, yes, consumer business is the next growth engine, and we are chasing it quite successfully. From around less than 50 crores before 5 years, we are now already more than 450 crores in terms of the revenues from the consumer business, and we are pretty confident to reach our target of 1,000 crores by 2020.
Okay, just one more thing. You said volume growth was 15% for this quarter.
Yeah.
You're saying quarter 3 volume growth was 15% over quarter 3 FY17. Is that right? I wanted to confirm.
Yeah, yeah.
Okay, so could you break up volume growth for consumer business and institutional business?
So we don't provide the breakup, as I said, for both the segments.
But was institutional business volume growth in single digits or
consumer business? Yes, definitely. Consumer business are relatively larger growth in terms of than institutions.
No, it was institutional business single digit volume growth or double digit volume growth?
I will not be able to comment very specifically also, but I can definitely say that consumer business had a larger growth than the institutional one.
Okay, and skim milk prices have increased, right? Hello? Hello?
Ladies and gentlemen, this is the conference operator. The line for the management has dropped. Please stay connected while we have the management reconnected. Ladies and gentlemen, thank you for patiently waiting. We have the line for Mr. Nirmal reconnected. So you may go ahead.
Yeah.
Hello. We still have the question for Mr. Bhuvnath on the line.
So just wanted to know, skim milk prices have increased, right, during this quarter?
Yeah. Skim milk.
Yeah, skim milk.
No, skim milk prices have not really gone up this quarter. The overall market for skim milk, and I think you are talking about skim milk powder prices.
Yeah.
So yeah, they are bearish and they have not increased for this quarter. And actually they are down than the last year.
Okay, great. Thank you. Yeah.
Yes.
Thank you. We take the next question from the line of Prateek Lambe from ARM Research. Please go ahead.
Hello. Yes, good morning, sir. And congratulations for very good results on quarter-on-quarter basis. Actually, my question was regarding the revenues about your retail segment or the retail business itself. Because, sir, we can see that your gross margins have improved significantly as compared to Q3FY17, but they are not showing into your EBITDA margins. So, and the reason for it, you have proposed that there was increase in the transportation costs or selling and administration or maybe the advertisement costs. So basically, our community or maybe the analyst community are very keen to know what are the numbers for your B2C business or the retail business, sir.
Numbers and in what sense?
In terms of revenue.
In terms of?
Revenue, sir, from retail business.
Okay, so Prateek, we don't provide a breakup as such of the split in between the retail versus the institutional business.
Okay, but you have been telling the other person that those will be definitely higher than your institutional sales.
Surely.
Okay, so I think then the company is quite ambitious or on the line of achieving the significant 30 to 50% growth in terms of consumer business, right, sir?
Yes.
Okay, and another question would be, would you please comment on the ice cream sector that you have been initiated in 2017? How is it going?
So ice cream is going good. We have launched our range of ice creams under the brand name Wallop in March 2017, and it has been a test launch. We have launched it in only 4 districts like Nashik, Ahmednagar, Jalgaon, Dhulia, and I think Jalgaon. Okay. So in all these 4 or 5 districts, we have got very good results. We are present in around 2,000 outlets now. And we are going to continue our soft launch for next 3 to 4 quarters further. We are not going to, the target is basically to take this ice cream across Maharashtra and to become a significant player in Maharashtra in next 4 to 5 years. That is the target. In 1 year, we have understood ice cream is a new segment for us. And since it's a new segment for us, we want to study it further about what products work at what price range, what is the distribution model. And in ice cream, we are yet building on that model. The revenues right now are pretty low, and those are expected to remain low for next 2-3 quarters. And once we have the correct model in our hand, then we will be expanding this particular product to the geography, particularly starting with Maharashtra. And Maharashtra itself, we want to be a large player, post which we will be taking the market outside Maharashtra.
Okay. So, and can you give me what are the EBITDA margins in this ice cream business? And as well, you have said that the transportation and all the advertisement costs have been incurred for this B2C network. So, amongst this B2C network, on what products are you focusing specifically? Would it be right to call ice cream or maybe the other products would be correct to consuming these costs?
So ice cream we are focusing, yes, that's correct. But since it's a soft launch and the geography is also limited, that doesn't contribute largely to our overall spend. That might start contributing in next years to come when we will plan to expand it to more geography. Right now, main products of focus are fresh milk, curd, ghee, paneer. These are particular products which are of large focus. And reason being that those are the primary products which we are targeting, which would contribute highest in terms of the Vision 2020. In terms of margin in the ice cream business, while EBITDA margin is expected to be around 15 to 18%, because normally the industry operates in the range of 15%, and we being a dairy player have a larger advantage, so we are targeting 15 to 18% in terms of EBITDA. But right now we are not seeing that EBITDA because this is a soft launch again, and the volumes are not enough to generate this kind of EBITDA margin as of today.
Okay. All right, sir. Thank you so much, sir.
Thank you.
Thank you. Yes.
Thank you. We take the next question from the line of Prashant Kutti from Sundaram Mutual Fund. Please go ahead.
Yeah, hi. Thank you for the opportunity. So just one clarification over here. I guess in the presentation you mentioned that our value-added products are about 79% and 21% is milk. Am I correct by saying that statement?
Yes.
And this is for the entire business, right? Including retail? And,
yes. Yes.
Is there any way to probably give us some sense as to how much would be consumer over here? Because I'm just trying to understand the EBITDA margin part over here, because you said that EBITDA margins, obviously as the scale of consumer improves, the EBITDA margins would obviously be going up. So just want to understand over here from a consumer business perspective, how would the mix be of value added to?
So if so right now out of the total consumer business, at least 35 to 40% right now comes from fresh milk, and the rest 60% comes from other products like curd, ghee, and all. So that's a 40% contribution from that, and rest of the contribution of liquid milk comes from the B2B business, which is basically again where we provide processed milk in concentrated form to companies for manufacturing their nutritional supplements.
Sure. So sir, what we're trying to say is that this 60% curd, which or the value-added products which are currently having in the consumer business, this could potentially go up to something like a 70-80% kind of a number. Is that the way of looking at it? Why
not really?
Because on one end we are also increasing our procurement as well. So I believe there will be a good amount of liquid milk as well. And since we're feeding those markets, we'll be feeding it with liquid milk as well. So what's the target on that part from the consumer?
So see, we as a proportion, fresh milk will continue to remain as a significant proportion of our overall consumer business. Because liquid milk, while relatively the margins are lower,
right.
But the advantage what we enjoy is that we have our plants at strategic locations. So while Bombay is a large market, we have a plant in Bombay. Second, whatever our main plant near Shirdi, that also has larger cities around it. And so the fresh milk, whatever we collect, we are immediately packing and distributing it in the same region. As I also mentioned, we have also started a new packaging station on a third-party basis before a couple of months in Latur, and we are also very shortly planning to start our milk packaging in terms of Nagpur. Whatever milk is procured from the nearby regions directly go to the packaging stations without coming to our main factory. It saves on our transportation costs. Second, liquid milk, particularly the fresh milk, is definitely a very important segment to be in. The reason given is that creates a larger network. On that network, which is basically a trade network and a consumer network as well, which is very, very important to sell your value-added products like dahi, like lassi, like chai, which are of high gross margin. So with milk, as a daily consumption, you are able to reach too many households, which ultimately creates a strong brand loyalty. And again in milk, if you see, there is not any significant private player in Maharashtra. There are cooperatives doing a good business, but there is no single large private player in Maharashtra, which you could see in other parts of the country, especially in southern India. So there is a gap, we believe, and that is the gap we are trying to fulfill. Again, what works to our advantage is our high quality milk. Because particularly for fresh milk, you need to have a very high quality milk, which has always remained our strength. Hence the focus on the fresh milk, and hence we don't see that value-added products will will go more than 60-70% in our total consumer pie, it could remain at the same level, and fresh milk also will continue to grow.
But technically, from a margin expansion perspective, it will have to be more driven by more volumes, and maybe that's how it's going to be, right?
So more volume in terms of consumer business.
Okay.
Second, the margin expansion will be driven by high-end products like cheese particularly, which are extremely low right now because the plant is relatively new. It has started before 2 years. Now the capacity utilization is growing. And third is particularly as we build the cold chain network, right now transport and distribution costs are higher. As we go forward, we will see them going down as the volume increases. Those will be basic margin drivers. Apart from that, in next 2 years, we are going to spend a good amount of money, particularly on marketing and brand building, which will eventually help us to increase our margins at the trade level and at the consumer level, which we are not doing right now. Because right now we are chasing volumes in consumer business, not margins really. But after 2 years, we could consolidate and we could basically change margins, make some corrections, which could also improve the margin. So these are a mix of these 4-5 initiatives which we will be taking to drive the margin growth in consumer business.
Sure. So my next question is on the other expenses side. Now, while I understand this year's you did have a volume growth as well, but despite having a cut in your milk prices, but typically, sir, you also said that you're giving a lot of promotions to the consumers as well. Do we see that thing to be going forward, or probably you expect the other expenses number to maybe come off a bit? Well, I'm just referring to the promotional part. I'm not referring to any other ad spend numbers and the other distribution spend numbers.
So in terms of promotions, we will continue this aggression in terms of acquiring more consumers through promotion, because our growth targets in consumer business are pretty aggressive. Right now, we have been successful in acquiring new consumers through promotions. Because since it's a food product, it is very important for the consumers to taste it. Most of the consumers we acquire are not really the consumers who are consuming dairy products from other companies, but there is a very large segment which is actually preparing all these dairy products at their home.
Right.
For them, it is very important to taste the packaged dairy product for the first time, and hence we believe more on trials and promotion. And so we will definitely see that continuing in days to come.
Promotion will still be an integral part of it. Sure. And my last question is, sir, on just a clarification with it. What is the income you said that you'll be generating from these franchisee stores, sir? I didn't get that part. I'm sorry, you just missed out that number.
It would be too early to say right now because it's a very new thing. Maybe in a couple of quarters we'll be able to get a better hold of in which kind of geographies, what kind of outlet give what kind of revenues. And in that point of time, we will be having a fair clarity about how much total income could be generated out of this 500 stores.
Okay. Now I'm just referring to how much would be your share to be coming. I'm just referring to that. I do understand that it will probably take its time to seed. I'm just saying, let's say if a full-fledged, let's say, outlet which you're talking about, let's say a 7,000 to 9,000 per day outlet is the revenue target which you're talking about. I'm just wondering how much would be your share which will be coming to it is what I'm asking in that sense.
It would again, be too early to say in terms of this because these outlets are only in Maharashtra. Right. And while yes, we expect in a couple of quarters it could be clear, it could be a good amount of revenue share. But more importantly, these outlets drive branding. And with these outlets, while that particular outlet could sell certain things, but the sales in general trade around that outlet has go significantly up. That is what our experience has been.
Okay. Sure, sir. Thank you very much. Thank you. All the very best to you.
Thank you. We take the next question from the line of Ronak Jain from Vibrant Securities. Please go ahead.
Yeah, hello, sir. So first of all, I just wanted to confirm that we procure only cow milk, right? So in our region, we don't have buffaloes.
Yes.
Okay. So second question would be for the procurement. So the reason why the procurement prices went down this quarter was because of the seasonality effect. Because of the winters, we basically get to procure more milk. Is that the reason?
Yes.
So we will witness a increase in the price from maybe for the next quarter.
Yeah, next quarter as summers approach, we will see a slight increase in the prices. Maybe not to the levels which they were there earlier, because while there is a seasonal factor, but at the same time, there have been good monsoons consecutively for 2 years, and the availability is much better. So there is also slightly bearish market in terms of inventories in India, and hence that also has some pressure on the pricing. So yes, in summers definitely we will again see the prices slightly going up, but we don't expect a very large uptake in terms of prices.
Okay, got it. So my next question would be for the B2B segment. So what would be our B2B operating margins for the B2B segment?
In the gross margins, B2B, while B2C is in the range of around 26 or 28%, B2B is in somewhere in the range of around 16 to 18%.
You're talking about gross margin, EBITDA margins, right? Operating margins?
Gross margins. And EBITDA margins, both the segments would be in the range of 8 to 9% in terms of EBITDA margin.
For both the segments, 8 to 9%?
Yeah.
Okay. So just wanted to confirm, because we are not, for the B2B segment also, we are not into like commodity products. So we are also making the value-added products for our B2B clients. So the capacities that we have already established for them, do we leverage the same for our B2C operations? Or we have built
some of them. Some of the capacities are common.
Okay. So basically the capex requirement in the B2B operations is leveraged in the B2C also. So
correct.
That way we don't have to do much capex. Going forward, what are your guidance for the capex?
We don't expect any